This is time sensitive. Right now, there is a multi-billion-dollar discrepancy sitting in the global gold market between what the official records say moved and what the physical trade data shows actually moved. And if you are not paying attention to where that gap leads, you are going to fundamentally misunderstand who is accumulating gold, how they are doing it, and what the real pricing pressure looks like from here. I have been sitting on this research for about a week, running down every thread I could find in the public data, and I am recording this right now because you need to see this before it becomes obvious to everyone else. I am recording this right now from Phoenix, and I want the timeline on this to be crystal clear, so comment below with what day and date you are watching from, because this story is actively developing, and knowing when people are finding this helps me understand how fast the information is traveling. And real quick, if you value this kind of investigative, follow the data work on the gold market, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this depth and not just the surface narrative. Now here is the claim that has shaped how most retail investors understand the global gold market for the last several years. The claim is this: gold flows are largely transparent. Central banks report their reserves. Refineries process and redistribute. Trade statistics track the metal across borders. And if you want to know where gold is going, you read the official data. That is clean. That is also incomplete. Because when I traced where these specific unaccounted volumes were actually coming from in the publicly available trade records, it was not from some obscure database that requires special access. It was hiding in plain sight in the reconciliation gaps between what major exporting jurisdictions report sending and what major importing jurisdictions report receiving. Those gaps are enormous. And they are not random noise. They follow a pattern that tells you exactly where the invisible gold is going and who specifically does not want you to know they are buying it. So in this video, I am going to break down three things. First, what the Swiss re-export data reveals that almost nobody in the retail conversation is looking at. Second, what the Hong Kong and Singapore trade statistics tell you about which destinations are accumulating gold outside of official reserve reporting. And third, what the aggregate picture means for how you should think about real gold demand versus the reported version. You are going to walk away understanding the gold market at a level that most commentators never reach. So let us start with Switzerland, because this is where the physical trail begins, and it is one of the most information-rich public data sources available to anyone willing to pull it. Here is what nobody wants to say directly in a gold commentary world that often takes official figures at face value. Switzerland processes a dominant share of global gold refining and redistribution. Gold from mines in Africa, from scrap recovery in Asia, from central bank lending programs in Europe. It flows through Swiss refineries and gets recast into the bar formats that different buyers require. And the Swiss Customs Authority publishes export destination data that is granular enough to show you not just how much gold is leaving Switzerland, but specifically where it is going. When you compare what Switzerland reports exporting to major destination countries against what those countries officially report importing, the reconciliation should be close. In a transparent market, it would be close. What you actually find when you run that comparison right now is that the gaps are not small. Think of it like a restaurant where the kitchen logs every dish that gets sent out. The serving record and the table orders should match. But in this kitchen, certain tables receive significantly more dishes than they have ordered plates on record for. That is not a bookkeeping error. That is a delivery going somewhere that is not being officially logged at the receiving end. The Swiss side of the equation is documented. The receiving side is either unreported, underreported, or routed through intermediary storage jurisdictions that introduce a timing gap before the final destination appears in any official record. Now, here is the skeptical alternative, and I want to address it directly because it is a fair challenge. Could the reconciliation gaps in gold trade statistics reflect legitimate factors like transit storage, refinery processing time, bonded warehouse holdings, and normal data reporting lags between import and export jurisdictions? Sure, and in normal conditions, some portion of the gap is exactly that. I am going to say something that might annoy both sides here. Trade statistic reconciliation gaps in commodities are not unusual, and many of them do reflect timing and methodology differences between how different countries categorize and report physical goods flows. That is plausible here is how it can fail. The specific pattern of these gaps is not random across destination categories. The destinations showing the largest and most persistent gaps between inbound Swiss gold flows and officially reported reserve additions are not random developing countries with weak statistical infrastructure. They are sophisticated financial jurisdictions with advanced customs reporting capabilities. When a jurisdiction with high statistical capacity shows a persistent large gap between what it receives and what it officially records as arriving, that is not a data infrastructure problem. That is a documentation choice. A correlation is not a contract, but persistent directional gaps in precisely the jurisdictions with the strongest accumulation motivation and the least transparent reporting culture are a signal worth following seriously. Stay with me on this because it matters for understanding the full scope. The Swiss data is one thread. The UK trade data is another. London remains the largest physical gold trading hub in the world, and the flows through London clearing tell a parallel story. What leaves London physically and what the official recorded destinations confirm do not always reconcile cleanly either. And the pattern of the unreconciled flows again clusters around the same destinations that show up in the Swiss gap analysis. When two independent data sources point at the same direction, the probability that it is statistical noise declines significantly. Here is a question for you, and drop it in the comments because I read everything. Do you think the gold trade statistic reconciliation gaps I just described represent genuine accumulation that is being deliberately kept off official records, or do you think they represent legitimate statistical methodology differences between jurisdictions? Your answer tells me how you are framing the transparency of the gold market overall, and I want to know where this community lands on that question. Now let us talk about Hong Kong and Singapore specifically, because this is where the trail gets particularly interesting and where the retail analysis almost never goes. Hong Kong has historically served as one of the primary physical gold routing points for flows ultimately destined for mainland China and other parts of Asia. The import and re-export data from Hong Kong Customs is publicly available and extraordinarily detailed by commodity category. When you compare Hong Kong's recorded gold imports against its recorded re-exports, and the residual that stays in the territory, the math does not always close cleanly. And the residual that does not cleanly re-export tracks closely with periods of elevated mainland demand, during which the official Chinese reserve reporting shows flat or minimal additions. Singapore plays a parallel role as a free trade zone hub where gold can be imported, recast, stored, and re-exported without every transaction appearing in the standard reserve reporting framework. Think about the house foundation here. The entire Western financial system is built on a documentation framework that assumes gold held in official reserves gets reported. But that foundation has a structural gap in it. Significant volumes of gold can move through free trade zone structures and bonded storage arrangements without ever triggering the reporting threshold that makes it visible to the standard tracking systems. and changing that documentation framework would require every major jurisdiction simultaneously agreeing to much higher transparency standards for something they are currently motivated to keep opaque. That is like replacing the foundation of a building while people are still living in it. Nobody wants to coordinate that effort. Now, the practical implication of all of this is not that you should panic. It is that you should recalibrate how much weight you give to official gold demand figures when forming your view of price. Here is what it means if the invisible accumulation thesis is correct. The actual sovereign and institutional demand for physical gold is materially higher than what appears in any official data set. The price at which that demand is being satisfied is the current market price, and the volume of gold being absorbed at that price is significantly larger than the consensus demand model suggests. That means the above-ground supply available for other buyers at current prices is being drawn down faster than official inventory figures indicate. That matters enormously for where price goes when something causes a sudden demand spike that the invisible accumulators cannot quietly absorb without price discovery catching up. Tell me in the comments, when you think about the real gold market versus the officially reported gold market, how large do you think the gap actually is? Is the invisible accumulation a small percentage of total demand, or do you think it represents a majority of the real buying pressure? Drop your estimate below because the range of perspectives in this community on that question is always more interesting than the analyst's consensus. Now here is your practical action plan. No drama. Step 1. Add Swiss gold export data and Hong Kong gold trade statistics to your monthly research reading. Both are freely available from their respective customs authorities. You are looking for divergences between reported outflows and confirmed inflows to major destination categories. Write down the gap size each month. When that gap widens consistently in one direction, it is a leading signal. Step 2. Do not treat official central bank reserve reports as real-time demand data. Treat them as lagging confirmations of purchases that were made months to a year earlier. The trade flow data gives you the leading signal. Decide this first when evaluating any gold demand narrative and weight the physical evidence accordingly. Step 3. If you hold gold as part of a hard asset allocation, the invisible accumulation thesis is an argument for being positioned before official data confirms what the physical flows have already documented. Do not make the common mistake of waiting for the headline confirmation before acting. By the time the official numbers catch up, the positioning window is already gone. Step 4. If you hold paper gold products, specifically unallocated accounts or ETFs, with limited physical redemption rights, the invisible accumulation story is also an argument for understanding exactly what counterparty stands between you and the metal. When physical demand pressure is higher than reported, the institutions managing those paper claims are under more stress than official figures suggest. Now let us map two plausible paths without pretending to predict the exact candle. Path 1 is the reconciliation and repricing scenario. The invisible accumulation continues at current rates. The gap between physical flow data and official reporting widens to the point where independent analysts begin publishing reconciliation studies that get mainstream attention. Institutional investors update their demand models upward. The structural supply-demand balance looks significantly tighter than the official consensus has been suggesting. Gold reprices materially higher as both existing holders and new institutional buyers update their views simultaneously. I am not predicting it, I am saying it is within the set of things this market is capable of doing, and the gap between physical reality and official narrative is the setup that makes it possible. Path 2 is the normalization scenario. The reconciliation gaps narrow as some of the invisible accumulation transitions into officially reported reserve additions. Several central banks that had been accumulating through unofficial channels choose to publicize their holdings either for diplomatic signaling or for domestic political reasons. The gap between physical flows and official data shrinks. The demand picture normalizes. Gold trades in line with the official consensus demand model rather than significantly above it. Same physical market, different interpretation depending on how much of the invisible demand chooses to become visible in the next reporting cycle. Both worlds can be true for different buying institutions simultaneously. That is not a crash call, that is a maturity call on the disclosure timeline. Now, here is the uncomfortable truth, and I want to say this without hedging. The poker table dynamic in the physical gold market runs deep. The largest accumulators at this table are not talking about what they hold or what they are buying. They are operating in a system that allows them to move the most consequential commodity in the global reserve architecture without triggering the transparency mechanisms that govern most financial markets. And they are doing this at scale that dwarfs what any retail holder can observe from the outside. Here is what nobody wants to say about the retail position in this dynamic. You are not sitting at the poker table. You are sitting in the observation gallery. You can see some of what the players are doing by reading the physical flow data. But you cannot see their hole cards. You cannot see their full accumulation position. And you will not see their exit strategy until it is already in motion. The best you can do is follow the physical evidence as closely as possible and size your position to something you can hold without needing to react to every headline that the people at the table want you to react to. Here are my 4 risk management rules. 1. Write down your gold allocation ceiling before you take any new position based on this thesis. If you are losing sleep, it is already too large regardless of how compelling the invisible accumulation evidence looks. 2. When your gold position runs, take some off. If it doubles, seriously consider trimming close to half. Lock in the original capital, let the rest run with house money. 3. Do not keep all of your gold exposure in one form or one location. The counterparty risk I described for paper products is real. Physical held in multiple locations and paper in a separate account with clear redemption terms gives you a more resilient total position. 4. The best time to act on an investigative thesis like this is not after it becomes a viral story. It is right now, while it is still something you have to dig into trade statistics to find. Excitement is a bad entry signal. Curiosity at this stage is a good one. So here is what we covered. The Swiss re-export data and the Hong Kong and Singapore trade flow statistics reveal persistent reconciliation gaps between what official records show moving and what the physical delivery data documents actually moving. Those gaps are not random, and they do not follow a statistical noise pattern. They follow a destination pattern that tracks closely with the jurisdictions and institutions that have the strongest motivation for invisible accumulation. The real gold market is significantly less transparent than the official demand framework suggests, and that invisibility is not accidental. The mechanism operating in the gap between official data and physical reality is doing something that most retail investors will not see or price in until the reconciliation becomes public, and by then the accumulation phase will already be complete. Stay alert. Do not let a clean set of official numbers talk you out of following the physical evidence that the trade flow data is already making visible. Now, here are my questions for you. First, when you think about the scale of invisible gold accumulation happening outside of official reporting frameworks, do you think it is a relatively small supplementary flow, or do you think it represents a majority of the real buying pressure in this market? And second, does knowing that the physical flow data routinely diverges from official reserve reports change how you size or structure your own gold position? Drop your answers below and include what day and date you are watching from. If you got value, subscribe and comment FinTalk OG so I know you want to follow up when new trade reconciliation data sharpens the picture on where this invisible gold is ultimately landing. And if this helps, share it with someone who holds gold but has never thought about the difference between what the official market reports and what the physical pipes are actually moving. Keep your head clear, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.